Let's come back. Now let's look at this picture. This picture compares the annual return between Dow Jones Index versus Scsc Composite Index. This stands for China, and this stands for US. The solid blue lines represents for Dow Jones Index, and the orange dot lines stands for Scsc, and this is the zero line. This is the zero line. What are the differences between these two lines? First, find that for most of the time, Dow Jones side is higher. Second, in general, both are downward trend. But there are something different. For Shanghai said it's downward trend here, and then at this time point, before May this year, it turns to a slight upward trend, and then downward again, and then upward. However, for Dow Jones, it is all the way downward. Now it seems here is a floor, may turn to upward, but we don't know yet. It's a big question mark here. And the third point, starting from late January, the Shanghai SET goes below zero. This is the zero line. That means the annual return of Scsc Composite Index goes below zero line. It means suffering from a loss. Starting from here, just before May this year, the Dow Jones side also goes below zero, right? That means the security market situations, both in China and the US, is not that optimistic this year, at least the first half of this year. We do expect the second half of this year we have a better results, but who knows? We will be expecting for that. Okay, this picture summarizes the differences between Shanghai Stock Exchange and Dow Jones in US for the first half of 2022. What about the situation between China and Japan? This is the annual return, their difference between Scsc Composite Index and Nikkei 225. Again, this represents for China, and this represents for Japan. The blue solid line here is Nikkei 225, and the orange dot line is for Scsc Composite Index. We find that except for this part and this part, the two lines is actually relational twisting. Again, relational twisting. But for these parts, situations are pretty different. This means if we look at this from a relatively longer trend or a big trend, they are somewhat similar to each other from the perspective of big trend. But there are lots of differences. Okay. And this is the zero line. After mid-January this year, both went below zero lines. Okay. From this perspective, they two are the same, or below zero, or negative return. And then let's look at what are the differences between the security markets in US and Japan. This picture compares the situation between US and Japan by using Dow Jones for US and Nikkei 225 for Japan. Okay, this is the situation. So what do you say about this situation? Different people may have different explanations, but you can have your own one. You can tell your own story about that. Okay, let's look at next. Just now we have talked about the comparison of periodic return between Scsc and Scsc, between Scsc and HKEX, between China, US, and Japan. These comparisons are all from the perspective of periodic return. Okay. Starting from this topic, we will compare these things from another perspective, which is holding period return. It's a whole new perspective, and we may have different ideas. Sometimes the conclusion or the results are the same, sometimes are different. First, let's look at the differences between SSE and SCSC. This time, we are looking at this question from the perspective of holding or investment returns. You may have a better understanding about the difference between Shanghai and Shenzhen. Okay. Now let's look at this picture. This is a picture comparing the expanded return. It is also called the holding period return or investment return. And the blue solid lines represent for Shenzhen side, and the orange dot lines stands for Shanghai Sen. Suppose an investor invests same dollar amounts in Shanghai Stock Exchange and Shenzhen Stock Exchange at the same time, which is January 2020, respectively. And after 1.5 years, what will be the results of these two investments? Okay. Again, this is the zero line. From this picture, we can find out for the investment in Shenzhen after 1.5 years, its investment return would be more than 40%. And its investment in Shanghai will be less than 20%, right? Well, this is the big difference, right? This is the big difference. And from the curves, we can also tell that the Shenzhen side, from investment return perspective, it is higher and significantly higher. It's almost all the way higher, right? Second, well, the trend, similar to each other. Similar trend. Third, the spread. Okay, the spread here is smaller, gradually gets bigger, and then relatively steady. Bigger, remains. Right? Now, what do you think about the differences between Shanghai Stock Exchange and Shenzhen Stock Exchange? Yeah, we have another difference. For the investment in Shenzhen, it goes above zero after half year in 2000 July. And the investment in Shanghai, okay, it goes almost the same time, goes above zero. This is the zero line. So this is what we can find from this picture. Yeah, these are the knowledge points in this topic case studies. And this is the Python script for these case studies. Here, we're still using the same Python command, compare security. So this command is so powerful. Actually, I must tell you that this command can compare almost all the major stocks and bonds in the global security markets. It can compare actually more than 50,000 stocks, variant stocks. And for the bonds traded in exchange only, because the Chinese interbank bond market is not open to this command. More than 50,000 stocks worldwide. It's so powerful, right? You can even compare the stocks listed in Tel Aviv or the stocks listed in Saudi Arabia, or the stocks listed in, say, Slovenia, Slovenia. All the stocks listed in Russia. Of course, it supports the stock listed in Shanghai Stock Exchange, Shenzhen Stock Exchange, Hong Kong Stock Exchange, Tokyo Stock Exchange, and the stock listed in Singapore Stock Exchange, Malaysia Stock Exchange. I'm not sure about the stocks listed in Indonesia Stock Exchange. For US side, the command supports the stock listed in New York Stock Exchange. Also for the stock listed in Brazilian Stock Exchange, Mexico Stock Exchange, or the stock listed in Argentina. And now we have a new measurement here called expanded return. So it's another name called investment return or holding period return. You may find different names in different textbooks. Now, let's update the period in the case studies and see what is the most recent situation of the comparison, especially in this year, from the perspective of holding period returns. We update the start date to January the 1st this year, and we update the end date to today. Let's see the new situation in this year in terms of holding period returns. And let's see the differences between Shanghai Stock Exchange and Shenzhen Stock Exchange. Well, we have the results now. Okay, let's explain this picture. So this picture, the starting period is January this year and ending at July. We are looking at expanded return or holding period return. And this is Shenzhen Stock Exchange. And this is Shanghai Stock Exchange. First point, we have to say they have a similar trend. Right? And the second point is, okay, for SSE side, we have less loss. Why we have a less loss? Because this is the zero line here, right? It is the zero lines. So both under or below zero lines means both suffering loss. So this means, well, this year is not a good time for us to do stock investment in both Shanghai and Shenzhen, right? If you look at this from the perspective of investment return, both below zero lines, makes me disappointed, right? Let's compare, okay, stock market versus bond market, and this time we use treasury bonds. So what do you think about the big differences of the investment in stock and in bond? Let me ask you another question. What are the critical or fundamental differences between an investment in stock and in bond? Theoretically, if we invest in stock, only theoretically, we may possibly have higher return. If our investment is at the right time, for example, a bull market. However, we have to undertake higher risk. However, for an investment in bond, especially treasury bonds, there is less risk to default, right? We will have definitely a lower return. Theoretically, not in reality. In reality, may not be a lower return compared to stock because it has lower risk. And at the beginning of today, we talk about the nature of security investment. Still remember? Just after 1 hour, we have the 2R, return and risk. So every time we have to talk about 2R, sometimes it's very difficult for us to make decisions because one investment maybe have a high R, a high return, and a high risk as well. Another investment may have a lower return but lower risk as well. So can we combine these two R's together? Yes, we can. We will talk about this in Module 5. We can combine the two R together into one single measurement. Then our job is to look for this single new investment. The higher, the better, right? Okay. Well, although we can imagine that from holding period returns, if we invest in stock, probably maybe higher. And if we invest in bond, probably lower. But is that true in reality, especially in this year or other years? Let's look at the question in this topic first. So what are the differences between stock and bond markets in China in terms of holding period returns or investment return? This is the question we expect to answer in this topic. Well, this is the picture. And in order to answer this question with higher confidence, this time we do a very long-term analysis, starting from 2010 till 2022. Not 2022, actually May 2021, because the date we make this picture is only on 2021, June the 29th. Okay, so it's actually here, right? It's actually here in May 2021. And the solid blue lines is SSE Treasury Bond Index, while the orange dot line is SSE Composite Index. Suppose the investor decided to do two investments here at the beginning of 2020, one in Shanghai Stock Exchange. Suppose he or she is eligible to buy market index products such as ETF. Well, at that time, probably we don't have ETF yet, but suppose we do so. And another investment, the investor buy treasury bonds. So after 11 years, what will be the results of these two investments? Okay, suppose now we are here. The investment results is, okay, it's roughly less than 10%, right? After 11 years, your investment return is less than 10%. Well, this is usually, I think, unacceptable, right? But nevertheless, it's a positive return. What if you have a negative return? You want to cry? Okay. Let's look at another investment results. Suppose we invest in treasury bond market. Our investment return would be more than 50%. Here, more than 50%. So what do you think? What do you think? Why the investment in Shanghai Stock Exchange is so low after 11 years? Because of the risk. Suppose you are lucky enough to sell your investment here, which is, I think this is 2015. Here is mid or late 2015. If you can sell your investment here, your investment return would be roughly 50% as well. Well, okay, before the market turns to bear market, you are lucky enough to escape or sell all of your investment. Okay, you can earn about 50%. So from this way, well, what do you think? So from long run, probably for some people, probably it's a good idea to do investment on treasury bond market, right? Here we can talk about the investors' risk preference. Do you know about this? Usually we have three fundamental type of investors' risk preference. The first type we call is aggressive. The features of aggressive investors is they look for higher return. And in the meantime, they are willing to undertake higher risk. Okay, on the other end, we call conservative. The conservative investors, they look for lower risk. And in the meantime, they are willing to accept lower return. Then we have investors in the middle. We call them prudent. Okay, these kind of investors, they want to do a good balancing between return and risk. In other words, they are looking for a balancing of pricing versus cost. Okay. So let's have a quick review on the investor's risk preferences. So let's back. Okay, for stock market, in this way, it is more suitable for aggressive investors. Right? And for treasury bond markets, it's very suitable for conservative investors. So before you make a decision to do investment, let's have a quick review on our own risk preferences. You may have a question to yourself. Am I aggressive? Or am I conservative? Or am I prudent? So if you have a clear idea on these questions, this may help you to make appropriate decisions of investment, right? And from this curve, we can also find out another unhappy conclusion. That means from long perspective, the stock market, at least the Shanghai Stock Exchange, has no value proposition. It's not meaningful, not very much meaningful to do a long-term investment in Shanghai Stock Exchange markets because this is 11 years results. There is only a return of less than 2%, right? Long-term investment, not much value propositions. So that's why so many investors in Shanghai Stock Exchange market do speculative activities, right? They relies on rumors rather than looking at the financial statements of the listed companies, right? Rather than doing a security investment analysis, they prefer to believing in rumors, unreliable rumors. Okay. Well, I feel sad about that. Okay. Well, this is the Python command. We are still using this very powerful compare security Python command. And this is for SSE treasury bonds. This is for SSE composite index, and this is for holding period return or expanded return or investment return. This is the period. Well, of course, we can update the period to this year, but I believe the results may not change a lot. Okay, but let's do it. What would be the situation between Treasury Bond Index and Shanghai Composite Index? We use investment return, and we update our starting date to 2022, January the 1st. We update our end date to today. I believe the result roughly the same, right? Well, the result is even impressive. It's even impressive. This is a comparison between Shanghai Composite Index and SSE T-Bond Index, Treasury Bond Index. Okay? it is in this year, the first half of 2022. And this is zero line here. At the beginning of this year, if we do two investments, one in SSE stock market, another in SSE treasury bond market, what would be the results today? Okay, our investment return would be around minus 10%, means a loss. Well, not a big loss, just 10%. If we invest in treasury bonds, I think 3 to 4%, or 2 to 4%, I'm not sure. Okay. In order to know the exact number, we can look into the variables, right? Let's look at the variables. This is the variables. Yeah. So in order to find out the exact number of the investment return for this one, this is the treasury bond index. Let's look into the details of these variables. In Python, we usually start a sequence from 0, right? So this is 0, this is 1. Then look at this one. 0. What about 0? Now, okay, we have the number. Now we have the number. Our investment return till July 21st is 2.25%. It's the investment, usually we say this, is the first half of 2022. So if in this way, our investment for the whole year in treasury bond market is probably maybe 4.5, roughly. This is our estimation. Right? This is an interesting use for the variables, right? If there are, of course, you can get more information from the variables because this variable store all the data returned by the Python command. If you just want to see the last 5, you can do this. Last 5, okay? Dot tail 5. Okay, so the last 5 variables, right? If you want to see last 10, of course you can change to 10, right? Last 10. Then you can see the exact number. If you want the detailed information besides the trend you see in the curve, right? Okay, let's go back. Yeah, the exercise case we have done together. Now, next, we want to know the investment return from Shanghai and Shenzhen Stock Exchange, respectively. Are there any differences in terms of investment return if we invest in Shanghai Stock Exchange or we invest in Hong Kong Stock Exchange? Now we can do that because we have a Hugang already, right? Okay, you can do investment both in Shanghai and Hong Kong. Of course, you can do, we have Senggang as well. You can do investment both in Shenzhen Stock Exchange and Hong Kong as well. Now let's compare Shanghai with Hong Kong. This is the situation, long-term situation between Shanghai and Hong Kong. Okay, for Shanghai side, we use SSE Composite Index, and for Hong Kong side, we use Hang Seng Index. And this time, we still start from 2010 till actually mid-2021, because the end date is 2021, June 29th. Okay, this is the zero line here. And the blue one is Hong Kong. And the orange one is Shanghai. Well, we find that from long run, the Shanghai side is fluctuating around the zero line. And the Hang Seng Index also doing the same way. But most of the time it's above the zero line, right? So from this picture, we can get a conclusion that the investment in Hong Kong side, from long run perspective, has a little more value propositions compared to the investment in Shanghai proposition, right? but only from long run. If you just focus on short-term period, you have to do speculative trading. Well, this is the Python command on that. And we are also very interested on the situation this year. What will it be for the situation this year? Because this year, both markets are suffering from COVID-19 pandemic diseases seriously. Then we update the period to this year. Sometimes this command provides lots of information describing the status of the execution. Sometimes we have error and we have warnings. Okay, but eventually it gets the data necessary. Well, this is the situation this year. This one represents for SSE and this one represents for Hong Kong. The blue solid lines is Hang Seng Index and the orange one is SSE. Well, for most of the cases, except here and except here, yeah, the Hang Seng Index is higher in terms of expected return. Even it is higher for most of the time, they are below zero, right? This year. So for this year, well, from these pictures, we have to say that it's not a good time to do investment in stock market, not only in mainland China, but also in Hong Kong. It's not a good year, right? So the whole world is suffering from COVID-19 pandemic diseases. Also, I think suffering from the Russian-Ukraine military conflicts as well. And these conflicts caused the sharp rise of oil price, the sharp rise of food price, and also caused the high inflation situation worldwide. Right? Whenever we have an inflation, serious inflation, the central government of every country may escalate market or benchmark interest rate. Once the benchmark interest rate rises, the market interest rate will rise following the benchmark interest rate. And whenever we have a higher market interest rate, our economic development will slow down, right? Because the cost of capital used by business gets higher, and then the profit earnings of business will be lower. Then the attractiveness of doing business is getting lower. Fewer and fewer investors want to put their money into business. So that's why the world business will slow down. It will be slowed down. That's the whole logic. Okay, and we have done the exercise. Next, we will compare the investment return or holding returns between China, US, and Japan. But before we do that, let's have a 10 minutes break. See you after 10 minutes.